Hey there, friend. Welcome back to another edition of the Premier Investments and Wealth Management Financial Program. My name is Doug Wagner. I'm your host. And before I introduce the gentlemen who are sitting around the table with me, I want to ask you a question. You've had a whole nearly half a summer in order to get ready for this question, too. The 250th birthday of our country. You've had vacations. Have you sat around and thought, am I ready for my retirement? Because there are a lot of people who have, and they've said, you know what, I'm probably not, and I think I need some help. Whether you're on that side or the other, and you say, I know I'm ready for retirement, you may still need to kick the tires on a wealth advisor, and that's why my friends at Premier Investments and Wealth Management are so ready for you to walk through the door, both physically and also online at premieriwm.com. Just go there, click Get Started, answer a few questions. They'll provide for you a one-page Premier Vision document that's like your roadmap to a financial future that you may not understand right now, but they will help you understand it. Not only that, a free no-obligation consultation. That means a free meeting for you. They'll come to you. You can come to them. They'll do it on the internet, however you would like. They'll explain the one-page Premier Vision document and what that financial roadmap looks like for you. I encourage you, solve that problem. Get that question answered. Move forward. Do it today. Don't procrastinate, okay? Go to premieriwm.com, click Get Started, answer a few questions, get that one-page Premier Vision document. You can also download a whole bunch of other information online, like the Investor's Guide series we'll talk more about during this program. But finally, I'll give you the number, 800-383-6590. That's 800-383-6590. Make your appointment today for Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Teams. Joining me directly to my right, a wealth advisor, certified financial planner professional, a CFP with over 11 years of experience in the investment industry. It's Dr. Casey Mushrush.
Just you, Doug.
How are you doing?
Doing good, neighbor.
Good 4th of July?
Oh, it was absolutely wonderful. We made it down to some family in Kansas on my wife's side, and they have a fireworks show that rivals like it's a county-wide thing. It's pretty awesome.
So that's pretty good. Out in the middle of nowhere?
Out in the middle of nowhere, right over the top of the dad or her uncle owns a construction company.
Right.
So he dug himself a lake.
Oh, well there. Nice. You know, I need a lake over there. How about we start digging?
I think that's pretty much what they did.
Yeah.
It's fun. So
That's great.
Kids go kayaking and do all sorts of things. But it's always a good time.
Good for you. I saw the lemonade stand. I'm gonna have to get some cash because I know you don't take cards. So
that's right.
Yeah, I'll get cash for that next time. Next to him, wealth advisor with over 31 years of experience in the investment industry, and he looks like he may only be 31 years old. He's getting younger every day. Jonas Everett, my friend.
Doug.
How are you?
How are you?
I'm doing fabulously. It's good to see you.
You know,
again.
July is Pink Shorts Month.
Yeah.
In the United States.
Yeah.
So you're
we
you're
call
a
this
trendsetter.
the Pink Shorts episode. So if you ever wonder what's behind the scenes, the Pink Shorts are. We just wear this up top. These guys have swimming trunks underneath as well. So, Jonas,
I'm not going to stand up.
Also here, he's the new sheriff in town. He's a vice president of wealth advisor, Premier Investments and Wealth Management, a certified exit planning advisor, or CEPA. His name is Elias Randel. Hey, Elias.
How you been?
I was choosing between a number of different pair of pink shorts for today because the weather's just so hot. I need something that's going to reflect the sunlight rather than absorb it.
You're pulling it off.
Thank you.
Good job.
Appreciate it. Everybody got a hobby. I can do everything from mocha to pink. That's a good thing. That's a good thing. Elias, we're going to come to you for the first question, okay?
All right.
Got Sam for this one. He says, I'm self-employed, so my income isn't the same every month. I had just one of my best months just now ever, so I used the extra money to pay down a big chunk of debt, max out my Roth IRA, and invest some money in a taxable brokerage account. But now I'm second-guessing myself because I'm wondering if I should have held on to more cash instead. Is there a good system for deciding how much to save, invest, or use to pay down debt when you never know what next month's income is going to look like? You get a complicated one right out of the box, but I know you got this.
I like these type of questions where the person asking the question also gives you some insight into their answer and what they're thinking. Sam knows a little bit of the answer. He needs some fine tuning and some help. So I think when you think about he's self-employed.
Mm-hmm.
income is not the same every month. What I like to see clients do is let's plan your budget around your worst month. We need to figure out if you had your worst month for 12 months in a row, can you still continue? And can you live and can you pay your bills and do everything that you need to do? And I think when you approach it that way, you're prepared for a worst case scenario. And Sam, being the gung-ho self-employed person that they are,
Go get her.
probably isn't going to have a worse month 12 months in a row.
Yeah.
So you're always, it gives you confidence because even with the unpredictability of your income, you can still make it go. And when you have your best month, now you have some extra money. And this person did a great job of paying down debt, maxing out a Roth. They put some money in a taxable brokerage account. So that's all good things to do. But I wouldn't start building a budget based on the best month. Now, if you repeat that for the next 12 months, well, maybe you can build a budget on that scenario. I don't think Sam did anything wrong with this. I don't think the goal of this person is to be able to predict their income perfectly every single month. I think if they have a budget and a system built around the worst case scenario for the industry and the business that they're in, when their income fluctuates, then they don't have to change their priorities and they can keep being consistent. And consistency in personal finance, it works and it pays off over time.
Yeah. And then what's helpful, Jonas, is that, when you say, hey, maybe you need a financial plan and you go to Premier Investments and Wealth Management website, you get the Premier Vision document, and then also that financial plan that goes with it. It helps to do a little more standardization so that you're looking at many years of being self-employed, potentially, so that they could kind of go through and say, what does this look like over time? And how do things fluctuate? And how can I prepare for the worst and then take advantage of the best times?
Yeah, the value that we give small business owners is time, basically. So Sam is hustling. He's running this business. He may not want to do the financial planning part of it. He may not want to manage his Roth IRA or set up an emergency fund, things of that nature. So our small business owners kind of rely on us just for the time, the delegation. And most of them like to run their business. They don't like doing this stuff.
Yeah. And a personalized plan. Go ahead.
So I got a question for you, Elias, because I think you had a really good answer there. But would your answer change? Because just a note that I jotted down a little bit as you were talking there. Would it change depending on the amount of cash that he has on hand? Because if he has $1,000 on hand, would that change your answer versus if he's sitting on $10,000, especially if he did have additional funds to put into that non-retirement account?
Yes, that would change my answer. With Sam being self-employed and having unpredictable month-to-month income, his emergency fund, cash available, becomes even more important. So my answer was probably assuming that this person does have a good emergency fund. If they don't, then they absolutely need to. And that would change. Well, for Sam, it's going to change a bad month. I wouldn't change the approach of budgeting my year off my worst month. I would continue with that and figure out what to do with the surplus.
There we go. Okay, that works. It's Premier Investments and Wealth Management, and we've got Elias and Jonas and Casey here with us here. PremierIWM.com is the website, and you can call. You can actually make your appointment online at PremierIWM.com. You can actually see what these folks look like as well, which is kind of fun. And then on top of that, there's lots of downloadable stuff. But Sam and other people, you need to understand that one-page Premier Vision document is critical, and it's sort of wealth accumulation plan, a wealth management plan is critical, whether you're a self-employed business person or maybe you work for a company that's got a 401k or you work for a company that's got a 403b. Get in touch with Premier Investments and Wealth Management, PremierIWM.com. Call 800-383-6590. Jonas, liked your intermediate answer to that question and directing to the self-employed and small business people. I know you love working with them. I'm going to go to a question to you from Matthew, who wants to know, a few financial podcasts I follow always recommend meeting with a financial advisor after you've accumulated a decent amount of money. I've reached that point, but now I've put in all the hard work paying off debt and building a nest egg. I feel like I'm on track, And I wonder what value an advisor could actually bring to me at this point.
That's a great question, Matt. One of the things that we do for people, it looks like congratulations, you've done 99% of the hard part. One of the things that we help people with is there's a really big difference in sets of skill sets when it comes to accumulating money and managing wealth. And ultimately, what we try to do is we take people through a financial plan. I can come up with a couple of different scenarios. I had one customer, he was financially independent before he called me up. His wife enjoyed listening to us on the radio show, so he came in. We did the financial plan, and I'll never forget what he said to me after the financial plan was completed. He said, "That's it. That's all I needed was the validation that you gave me from this plan that now I can retire." And he also wanted to know that he was ahead of his peers.
Yeah.
He was kind of beating his chest a little bit, walking out of the office like a rooster a little bit. And that's all he needed. So one of the things is validation. Another way that we help people with wealth accumulation is getting out of the way of their own selves, basically, getting out of the way of making any mistakes. And it kind of reminds me of a story that Casey and I have some mutual customers, and we talked about this before. They were fascinated by one of the big, beautiful bill tax strategies, and they wanted to get more research. They went to a workshop, and Casey's kind of an expert in people not making huge mistakes in their financial plans. So before they did this big tax strategy, Casey pointed out to them, Casey actually did about 5 to 10 hours of research and pointed out that this will cost you $30,000 to $40,000 in taxes. This is actually a huge mistake. And they said, "Thank you, Casey." And then "Thank you, Jonas, for sending me to Casey." So one of the things that you might not be thinking of, Matt, is there's some mistakes that just by not doing this on a professional basis, if you've done a great job accumulating wealth, look at all the people with wealth in our country that have advisors. They don't do this they don't manage their wealth by themselves. So again, the validation that you may need, and then secondly, getting out of the way of your own self, getting out of the way of making big mistakes later on. But ultimately, great job, and I think that you're a great candidate for a financial plan. So, Matt, maybe it's time, Matt.
Yeah.
Maybe it's time for a financial plan.
Maybe it's time. Also, the one thing I didn't see in here, and the one thing I'm shocked that I didn't hear from you, he never mentioned any sort of spare tire, no emergency fund. He said he's got a nest egg. To me, building a nest egg means he's looking to build that investment. He's paid off all of his debts, but that's one of those critical things that I know that every one of you sit down and talk about. It's one of those things to make
Well,
sure.
I knew you were going to help me with that.
Well, okay,
Doug.
I got you.
See, I signaled for the chubby knuckleball pitcher at the end of the bench to come in and throw the last strikeout. So thanks for helping me with that, Doug.
I'm throwing the ephus. It's like the Bugs Bunny. 1, 2, 3 strikes, you're out. 1, 2, 3 strikes. Men of a certain age and women of a certain age will get that joke if you've ever watched Bugs Bunny. Elias, I'm not sure that's in your wheelhouse yet.
Nope.
Casey, you might have.
It was the slow ball.
Yes, that it was.
I know
Okay,
exactly
there we
what
go.
you're talking about.
That's too good. Thank you so much for watching and listening. It's Premier Investments in Wealth Management Financial Program. Doug Wagner, your host, along with Jonas Everett, Elias Randel, and Dr. Casey Mushrush.
Good to see you, Doug.
800-383-6590 is the phone number. Call for your appointment today or go to premieriwm.com. Premier Investments in Wealth Management named to Forbes 2026 Best in State Wealth Management Team. Casey, for you, a question from Willow. A colleague of mine recently got a new bike, said he was able to buy it with funds from his HSA through our employer. I always thought those funds were for healthcare expenses only, or you were charged a penalty, but he said there was no penalty. Could that be possible? And I have an addendum from my personal issue coming up after this, too.
Perfect. So let's start with a couple of things here. Willow, thanks for sending this in. The answer? Maybe.
It depends.
But it depends a lot on documentation more so than anything else. So let's just run through a couple of different things when it comes over to HSAs and these distributions out of there. So with an HSA or health savings account, it is a spending arrangement that you can put money in on a tax deductible basis, so you can put money in tax deductible. You can pull it out tax-free if it is used for qualified medical expenses. Now, if you go over to the IRS, they have basically an entire circular or an entire publication that talks about what types of expenses actually qualify as qualified medical expenses. A bicycle may or may not actually be a qualified medical expense. It really depends on how it is being characterized. Now, bicycle as medical equipment, that would qualify. Bicycle as recreational equipment would not qualify. And so there are certain, call them categories, that are these dual use or dual representation type expenses that, depending on, again, it goes back over to documentation, will depend on whether or not that distribution would be able to be taken from that HSA on a tax exempt basis. Now, a couple of things on there that if you are looking into this, again, keep in mind purely recreational equipment is not going to be something that qualifies. So, for example, I bought my kids some skis because we like to go skiing in the wintertime. We could not take that as a deductible expense. Skis are equipment that is purely recreational. Now, interestingly enough, on that same website, they did have a wonderful link directly over to their telehealth provider that you could go set up an appointment to get a letter of medical necessity, which then could be taken as in order to go and try and get some of those different things qualified. So, for example, a bicycle, if you're actually looking at maybe if you are obese and a doctor has said, hey, you need to get more exercise, if you can get a letter of medical necessity that specifically says this individual needs to get a bicycle to increase their activity levels, that could be a qualified expense, at least at this point in time. So there are some really kind of odd mechanisms, at least when it comes over to what qualifies and what does not. So, but really, again, this really becomes over to very much following the documentation procedures and making sure that the correct documentation is provided to that HSA provider in order to make sure that that is actually a tax exempt or classified as a tax exempt distribution. Otherwise, Willow, you are correct. Any distribution that is taken out that is not done for a qualified medical expense would be subject to a tax and penalty.
Tax and penalty. Okay. Did you something you wanted to say, or were you just like?
I was just wondering if there's a way to somehow use an HSA to buy pickleball equipment, because it would be medically necessary to play pickleball to get more exercise.
Well, I think it probably depends. And if I were a doctor that were listening, I think if somebody comes in and asks for pickleball equipment, you better ask them, are you playing with a beer in your hand or not? Because if the answer to that is yes, well, I mean, I guess at least you're standing up, I suppose. So.
Exactly. That's too good. Okay, point of personal privilege. So you may or may not know, I was one of the people who unfortunately went through a reduction in force here recently. But prior to that, I haven't, I can't remember HSA, FSA, but the point is I had money that I put away inside that whole thing. And I sort of, after a few years, I gauged, okay, this is the amount of money that I typically utilize on a yearly basis. So I'm going to move the rest of it over into an investment side of it, which I didn't know until literally the engineer said, after one of our shows at the radio station, he said, well, that's what I'm doing. And I was like, I had no clue you could do that. Here's my question. Am I able to go back in to grab out the cost basis of that and repatriate it into my actual flexible spending account for utilization from here through the remainder of the calendar year when they say that would be done? Not the growth of it, just the cost basis.
Okay, so is the contribution that you did still in an HSA, or was it a different account type?
It was moved into an investment account.
Just like non-retirement, was it IRA, 401k, was it a retirement account? It would depend on the type of the investment. So if it was a Roth IRA, you can pull your contribution back out. If it was not in some other form, then the answer is probably not.
Okay.
So it very much depends on what the actual contribution in and of itself is. So what you're saying, I think, is can I go basically undo what I've already done to recharacterize this as an HSA contribution? Probably not.
Okay. Gotcha.
Now the other thing too, and this is actually a really good point. You can do investments within an HSA account.
Right.
So if you were investing in an HSA account and you were just freeing up additional cash within the HSA,
That's what I did.
okay, yeah. So inside of HSAs, and this depends. I know of at least 3 or 4 different providers that within the HSA account itself, you can put that into an investment structure.
And they said this is not available for daily use.
Correct.
Yeah.
You would have to actually sell out of it to free up cash that then you could actually utilize in terms of your expenses or medical expending. And one thing too, generally speaking, insurance premiums are not a qualified expense. However, insurance premiums for COBRA, so continuation of benefits in the event of a job separation, actually is a qualified expense in terms of those distributions out of the HSA. So again, very, very specific when it comes over to the types of expenses that actually do qualify.
Doug, do you have a pen and a paper handy?
Just in case anybody was really curious.
I'll have you write down 363-3811. You need to make an appointment.
Well, I just did. It was an impromptu one, but this is why you come to these guys. They're professionals, and you know what? Ultimately, I'm going to take that. I am going to talk to the company that handles this whole thing and go back to make sure that everything is copacetic. But I appreciate that. This is the kind of thing where this is what you get when you work with wealth advisors at Premier Investments and Wealth Management. It's more than just, hey, how do I make as much money as I can so that I can retire with as much money as I can to do the things that I want when I want. It's everyday life. It's literally walking with you through the fallow times when maybe you are unemployed, as well as the times when you are just feasting at the table along with everybody else. That's what Premier Investments in Wealth Management does for you, is they can help you make sure the highs don't get too high, the lows don't get so low. They can keep you right in that level middle where you feel the best. Premier Investments in Wealth Management. These folks will work with you both the front office, the back office, to do everything you can. You need to get your personalized plan right now, though, by going to premieriwm.com. That's premieriwm.com. Click Get Started. Answer a few questions. They'll provide the one-page Premier Vision document and a free appointment to go over it, too. They'll come to you. You can come to them. They'll do it on the internet. premieriwm.com or call 800-383-6590. Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Team. All right, we're going to move on to a question for everybody, and I'm going to come over to you first real quick, Jonas, for this one. John wants to know, do you think the shift from pensions to 401ks has fundamentally changed retirement now that you're working with some of the first retirees who have never had a pension to fall back on? Are you seeing differences in their confidence, spending habits, or overall retirement readiness?
Great question, John. Very intelligent question. Let me take you back to the middle 1990s when I first started in the business. I worked with retired school teachers, and back then, John, everybody retired at age 65. Nobody really thought of retiring early. Mm-hmm. And what happened was they retired under a pension system called IPERS, and they had full Social Security with no threat of a reduction in Social Security. So this was the most confident group of people that I could work with financially. Fast forward to today, confidence is lacking because I think that in the back of people's minds, they have to be in charge of their own retirement, and they really think that ultimately there's a chance that they could run out of money in retirement. So the confidence is a lot less today. Mm-hmm. Now, obviously, that's great for us because we get people in here to do a financial plan.
Right.
So people are worried about the cash-strapped Social Security system. They're worried about the cash-strapped Medicare system. They're definitely worried about the inflation year that happened in 2022 where groceries went up 8%. None of this was happening in the 90s. The 90s were the good old days where you had a guaranteed income for the rest of your life. You had 2 guaranteed paychecks. So ultimately, the responsibility is on yourself now, and the confidence is a lot less. However, Doug, again, back to the validation piece, a lot of people don't realize they've done a great job saving money. They just need to come in and do a financial plan so we can show them and we could build their confidence back up. So like you said earlier, it's not about the stock pick. It's not about the next greatest investments.
Right.
A lot of this investing stuff, a lot of this retirement is about confidence.
Very quick follow-up question for you, because I know we need to get these two in on this as well. I worked for a member of Congress back in the late 1990s, early 2000s. Pension Benefit Guarantee Corporation was the bomb back then. Everybody knew about that because pensions were starting to fall apart. So I think, do you look back at that, do you see that same level of skepticism with regard to individuals' 401ks, 403bs, IRAs, Roth IRAs, as you did with people who lost their pensions when they got bought up or had to go to Pension Benefit Guarantee Corporation?
Well, I think the sheer size of money in retirement accounts right now, you're looking at $43 trillion. There's not a lot of skepticism with the numbers. The numbers speak for themselves. So people have done a great job. They just need to come in and do a financial plan, get validation. And then if you haven't done a great job, we're going to be the first to let you know that you need to ramp it up if you want to retire at a certain age.
Elias, I'm going to go to you next. Have you noticed a difference in the way that people spend when they have access to their full 401k balance rather than a monthly pension check?
My answer is going to ride on the coattails of Jonas's answer a little bit. He brings up a very good point when he talks about confidence in spending. I don't think it changes the bigger ticket items. People are, and when I say that, I'm talking you take the family to Disney World, or you go on a cruise, you go on a European vacation. I don't think that is changed. I do think people spend less on a month-to-month basis when they have to rely on their 401k funds. Psychologically, they feel like they're spending their own personal money as opposed to the pensions money, which is really, by concept, it is your money, and then they're giving it to you as income and you're spending it. But I just think about myself. If I had a pension check coming in every month, like clockwork on the first of every month, what would stop me from spending it all?
Right.
On a pension and Social Security, you can live paycheck to paycheck, essentially, and the money comes back. Where 401k, if you spend all of your 401k and it's gone, it's gone.
By the way, you're not advocating to people live paycheck to paycheck
No.
on their pension.
Your phone's going to be ringing off the hook.
Is that something?
No, I'm not advocating to live paycheck to paycheck. I'm more commenting like psychologically.
I know, I understand. I just give a chance.
I just know myself and my relationship with money. If I got my 401k and I had a Social Security check and a pension check coming in every month, I'm spending every last penny of those two that come in every month. And then the 401k money for me is just going to be like extra stuff. But I think when people only have the 401k, I do think it skinnies down their month-to-month budget. They live a little bit more frugal. I don't think it ultimately changes like the bigger lifestyle that they live as far as traveling and doing stuff like that.
Right.
But it's easier to spend the pension money and the Social Security money. It doesn't feel like it's yours.
In Casey, this is something that I wanted to ask you about too. He brought up something about the idea of the 401k money is your money, but the pension money is the company's money, that it keeps coming. My understanding about pensions, and correct me if I'm wrong, is that the pension benefit goes away when the person passes away.
Generally, yes.
Typically.
So it typically a pension, you're going to see some form of annuitization that happens on it, meaning that it's going to end generally one of two times. Either when that individual passes away or if they have a covered spouse, when the second of those two people pass away too, because you can oftentimes see joint benefits that are paid out.
This has changed, in the move to 401ks has changed the way that families and individuals do estate planning over the years. Talk to me about how that's happened.
Yeah, so and again, this kind of gets back, I think, over to what Elias is talking about if you want to really get down to it, because typically what we see with the investment assets, when that's a lot more tangible, and I have something that is available, I can utilize that as an estate planning mechanism to give other assets or to give money away over to future generations. So whether it's a pre-tax asset, whether it's a post-tax asset, it's still something that can be given away and earmarked for that future giving compared to if you look at it more along the lines of a pension, well, that money is just gone at that point. So I think that might be something that plays into that a little bit, Elias, that, well, if I spend it, then I'm not going to have anything to give to the kids.
I agree with that. That is part of the psychology of spending someone's 401k money, where the pension, you can't leave it. You can leave it to your spouse.
Right.
If you set that up, but you can't leave it to your children.
But I think that's where you kind of look at maybe some of those old pension max strategies of what they used to be called, where it was the single life pension tied to a life insurance policy and some things like that can still be generating or can still create some sort of a some sort of a legacy aspect of it. It's just that those aren't, I would say, nearly as frequent maybe as what they used to be when we had significantly more pension dollars coming in.
I love that, Elias, that's just a great concept. The 401k is my money and I don't want to spend it. It reminded me of some customers that Mark and we take out to dinner a couple of times a year, and they just always want their 401k levels to be right around $1 million. And she made a comment after dinner, we were walking out, that, boy, I'd really like to buy a newer minivan. But I still like looking at that 401k level and being right at around $1 million. And I just thought to myself, Elias is right. You just explained what was happening there. She doesn't want to spend their money.
Yeah.
But if it were a pension, she'd be driving the latest minivan with all the bells and whistles. People don't want to spend their money,
so here's
but they want to
what
spend
I'm
a
curious,
pension.
Jonas. So do they only go out to dinner when you take them out?
I don't know. I don't think so. But they're really, and that's a good thing, because again, I think that they have tunnel vision for this savings amount. And I think that's fantastic, because that's how they created the amount. But at some point, I think Elias is right. That's why they're not spending that, because that's their money. And ultimately, what happens at age 73 anyways, Casey?
Yeah, you have RMDs.
Yeah.
They start to come out of your retirement
Uncle
accounts
Sam,
anyway.
he knows where to find you. He has 20-foot stilts. I saw him at the 4th of July.
Saw him too.
Picnic, and he could catch you in a foot race. So he's gonna get you when you're 73.
You may be able to set.
That's when she'll get her van, when the government forces her to take the money out.
It's the required minivan distribution. Yeah, that's the RMD. Get in touch with my friends at Premier Investments in Wealth Management. You need to get your personalized plan started today. You've heard about this, pensions, which in some cases I'm hearing are making a little bit of a comeback, 401ks, IRAs, Roth IRAs, emergency funds, all sorts of stuff. They can help you make sense out of all this, not only saving for your retirement or for your children's education or for whatever dream purchase you have in the future, but also making sure that you have today's, tomorrow's, the next month, years, couple of years sorted out so that you can get a better idea of where your money's going to go, how you need to put it together. Premier Investments in Wealth Management at premieriwm.com, or call for your appointment today, 800-383-6590. You can also get your appointment just by going to premieriwm.com. Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Team. Jonas, question for you from Jalen, if you're ready.
I'm ready.
Trying to decide the best way to pay for a $10,000 AC replacement. I have $20K in an emergency fund, or the HVAC company is offering 21-month 0 APR promotion right now, and I'm confident I could pay it off before the deadline. What option do you think makes the most sense? So $10,000 for the AC replacement, 21 months 0 APR, or pay for half of his $20,000 emergency fund in cash.
Jalen, what if I were to tell you that you already have 15 times more saved up in an emergency fund than the average American does? The average American has $1,700 saved up. So this is exactly why you have an emergency fund, the spare tire, to pay for this HVAC unit. I would use the money for that. And if you were planning on making these payments to a credit card company anyway, I would make these exact same payments back to yourself. Build that emergency fund back up. This is something that this is exactly what it's designed for. You're going to remove unnecessary risk. You're going to reinforce positive behaviors that you've had saving up this emergency fund. you're already way ahead of the average American right now. You have 20,000. The average American, again, only has 1,700. We've been beating this like a dead horse, Doug, for how many years in a row? And finally, we're kind of getting through to some of the listeners. We had one listener either email or call up our boss, Roger Abel, and said, you guys are really onto something with this emergency fund idea. I had 14 raccoons crawl in my attic and ruin my house.
Yeah, that's never
ever
good.
Since I started listening, I put money in an emergency fund. Thank you, and it's the simplest idea out there, but I think it's the best. Any money that you saved is earned money. So money saved is money earned. And you're going to need an emergency fund at some point. So great job, Jalen. Go ahead and use part or half of your emergency fund, pay for that HVAC unit, pay yourself back those credit card payments to beef back up your emergency fund.
Very interesting. I like that.
I think this is one where if you look at it just purely based off of math, your delta on this is, call it 4% if that's what is currently being paid on a savings account. I know it's somewhere around that range, right? We're having an $800 discussion. Like, the difference between, like, that's one swing one way or the other. I don't think that $800 is going to make that much of a difference one direction or the other to you, Jalen. So, is it perfectly optimized if you were to take the 0%? Absolutely. But you're bringing in additional risks, the risk of non-repayment, the risk of other things that could actually happen with those other dollars. I think you're way better off, again, to what Jonas is saying. Go ahead, pay it. And, at the end of the day, I think you're better ahead behaviorally, because it's just really not that much. It's not going to make that big of a swing, or in all likelihood, this isn't going to impact your life, at least in terms of pure optimization.
Well, if personal finance was just about optimization, it'd be so much easier and everyone would do it right. If it was, hey, just put it in a spreadsheet and do what's the most optimal decision, everyone would do it correctly every single time. But that's not the reality. The reality is there's behaviors that need to be built. There's emotions that need to be managed. It's not just what's optimal from a rate of return perspective.
There's stories behind the money, stories behind inheritances, stories behind wealth accumulation.
Right.
That need to be dealt with too.
Stories behind the band. But that's on another TV channel. Premier Investments and Wealth Management at premieriwm.com. One of the cool things, Jalen, they have an investor's guide series that you can download. A number of these. The 10 Critical Steps guide is available for you. Take a look at that. It may be beneficial for you.
I
Elias,
think you made an interesting point on that, Jonas. What's the purpose of the emergency fund if it isn't for this?
Right, absolutely.
Sorry, Doug.
No,
I just had that idle thought, and I was like, man.
Just don't let your air go out on a Saturday, because if you call one of these HVAC companies, they'll be like, who is this? Okay, well, I'll tell you what, we're going to charge $400 just to start the car to go out to see you, so you better call back on Monday.
See, and that's been my thing is I'd be tempted because I see that 21 month at 0% as me making money on that, because that, for me, I'm making money on that because I keep my money invested and I'm just paying it off a bit at a time. But I can understand there's two different ways.
But your delta on that is whatever the bank savings rate is.
Yeah.
Which is where I'm roughly looking at $400 a year times 2 years, approximately, because we're talking 21 months. That's where my numbers came from.
It was a much more culturally friendly reference than mine was 2 ways to skin that cat. So let's head over to Elias for the next question. This is a pretty long and detailed one. We make sure we got it in front of you so you could mark it up as you go along, because you're going to need to. Jen wants to know, I'm 57, my husband's 64. We both plan on retiring next year when he turns 65. He'll start taking Social Security, and we have some income from a rental property, but we will still need to take out about 8% from our investments for at least the next 9 years. We have about $1.35 million in our 401ks. At that point, our primary mortgage and our rental property mortgage should be paid off, and I will have started Social Security, so we could drop the withdrawals from our investments to 3 to 4% if needed. Are we on the right track, or am I taking a big risk by retiring at 58?
So this is not impossible to accomplish, but there are risks involved. So that's what I want to talk about. And the biggest risk, I believe, for situations where you're going to have what we consider a higher withdrawal rate is sequence of returns. And for the listeners, so sequence of returns is this year, did the market go up or down? Right. So we'll just use annual. So let's say the market went down. So that first year, that sequence was negative. And then the market went back up. So the second year, that sequence was positive. Well, the first 2 to 3 years of income strategy, a lot of it, to be able to be successful and sustain it, a lot of it has to do with the returns the client gets in the first 2 to 3 years. So that is something that needs to be managed, whether it's allocating cash to the withdrawals and just the overall portfolio and what's it going to be. The other thing I would have people do is to look beyond what is just average market expectations. You want to solve these type of scenarios against worst case scenarios. You should also plan for best case scenarios too and understand kind of the range.
Yeah.
But you should know in a worst case scenario, does this work for us? And a worst case scenario would include what I just mentioned. It's you're taking 8% and the market has a downturn of north of 20% in the first 2 years that you're taking the money out. That causes a big hurdle to get back to even.
Yeah.
And where the retirement income strategy becomes critical is this going to be 8% every year? Or we need to determine what is the dollar amount? Because let's say we have 2 positive, really good positive years in the portfolio. Are you going to take 8% of that new number? Or is it 8% of what you had when you started? Because if it grows, that naturally is going to come down.
Right.
Right? Where if you're saying, okay, I need 8% of 1.35 million, that's the dollar amount you need. Well, if you have a good year, you could easily have 1.4 or 1.5. So did you take 8% of the 1.3? Are you planning on that also increasing? I doubt they are. Most people don't plan for that. Those are the things I would start to think about. And then flexibility too, understanding that you may get down the path and may have to be flexible and adjust your withdrawals. Hopefully you never do have to adjust it, but let's say we do end up with a bear market that's longer and sustained. You should be ready to adjust your spending down when you're trying to sustain a higher withdrawal rate.
Right.
I think if you can understand all those risks, be comfortable with the income strategy heading into it, you're at least on the right path to getting a successful outcome.
Elias, talk to me real quick about stress testing this sort of thing. How do you do that? How does that mechanically work for you at Premier Investments and Wealth Management for your clients?
We use a stress test called Monte Carlo simulation. So it essentially takes someone's entire financial picture, what their planned spending is going to be or dollars coming out, and then runs it through 1,000 random sequences. So there's best case scenarios, worst case scenarios, and it's not a perfect science. I wish there was a perfect way to forecast the future. Yeah. Well, there is. It's a crystal ball. I'm still looking for one.
Yeah.
Do you have one?
I'll keep on the lookout for one.
You're going to look for me
I
too?
will. Yeah.
But what the stress test does is it does give people a good, reasonable expectation of what can happen. And I think if you can tolerate the reasonable expectation and you can live to the parameters of your income strategy, most of the time it will work out, and we're highly confident that it will work out for the client.
Okay, gotcha. That makes sense. You know what? You can get a personalized plan by going to premieriwm.com, clicking on Get Started. But also, you can make your appointment today online at premieriwm.com or by calling 800-383-6590 for Premier Investments and Wealth Management. Let's get that plan done, your personalized plan done. by getting in touch with Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Teams. All right, we're going to go to the table. We're going to go to Elias first and work our way back down the table here for listener question 8. Let you take a crack at this one at a time. Scott wants to know, I just turned 42. I've been at the same job since I graduated college 20 years ago. I think I experienced a reality check last year when several of my coworkers who were in their 40s when I started working retired. Retirement suddenly feels real and not that far away. I've always contributed just enough, 6%, to get the employer match, and then mentally filed retirement under future me's problem. My balance is just over $80,000. Over the last 6 months, I paid off the small balance I've been carrying on my credit card, started building an emergency fund, and increased my 401k contribution to 15%. I'm still worried I won't be on track for retirement. Is there anything else I should be doing? Scott wants to know. I'm going to turn to you first, Elias.
Scott has the switch has flipped for Scott. Mm-hmm. So here's what I see when I run into this type of situation. I know Scott feels like he's behind. Could he have started doing some of this stuff earlier? He absolutely could. But once the switch flips, people get really serious. And he's done the hardest part of this with building the emergency fund, getting some debt paid off, and increasing the 401k. That's going to have a major impact on his success. So it is not too late. Is he going to, had he been a great saver in his 20s and now he's 40, he's not going to accomplish what he could have, but he certainly can be on track for retirement. And most of the time, these situations like Scott is in, they just really hunker down and they keep it going. They're being positively rewarded for some of the behavior changes. And then, boom, 55, 60 years old, financially independent, and we're able to hit that goal.
It's interesting because he's like, I'm 42, and the guys I started working with 20 years ago when I started this job at 40 are now retiring. I'm now their age. You know, when I started, I meant what their age was. So it's kind of like it's capturing him, but it doesn't necessarily need to capture him because he's still got 20 plus years roughly until he retires, if he's the average person.
Yes, he does. And he said something in here that when he said, I've always done just enough to get the match. When you work in personal finance, that's like taking nails on a chalkboard. Even I could be at an event with my kids and maybe someone starts talking to me about what I do for a living and they say, oh, I just do enough to get the match. I always just want to cover my ears and put my head in the sand because I just know it's not enough. For most people, that's never going to be enough.
Yeah. Well, and that's something where you need a professional to help work with you on this as well. Jonas, you work with a lot of people approaching retirement. How often do you meet people who are in their 40s who think they're behind, and what do you talk to them about?
All the time. Most people that I meet in their 40s feel like they're behind. And what we've found is if we could just walk them through some good strategies, and I think Scott's on the right track. He's increased his 401k from doing just enough, where you don't want to get on Elias's bad side.
No, don't.
To maxing it out. Now Elias is going to send you some Christmas cards. We're okay now.
Yep.
And that's the big thing in the 40s. And one of the things that I would say is he mentioned something Scott did about future me problems. It's not really a problem. Let's turn that into an opportunity. Let's make this an opportunity at age 42. You have the foundation in place with a 401k. You have these people around you that are financially successful retiring. Mm-hmm. Let's get advice. Let's get some mentors from those people. And let's stay in the area of control, and let's put things in order before they exist. And let's start ramping it up. I beat this like a dead horse, but usually in their 40s, people are approaching their peak earning years.
Right.
Let's use this behavior that Scott's developed, and let's start ramping it up. Let's back the truck up. You love that, Doug, when I say that. And let's start really putting things in order to make you successful. And guess what? If you cross the finish line at 55, if you're financially successful, is that okay? Is that better than 65?
Could be, yeah.
So that's what I would do, Scott. Just always start putting things in order before they exist. Don't make it a problem. Make it an opportunity for
Casey, I'm going to come to you with the time remaining in the final one, but I'm going to say something about Jonas for what you said earlier. Is that I know you don't like doing this, keeping up with the Joneses, and doing the comparison thing because you don't look at your 401k every day, don't look at the value of your house every day, but at the same time, that validation of here's where I am compared to my peers. Here's where I can get compared to where I want to be. That's what that plan can offer up. That's huge.
Sometimes you need to step on the scales and get an x-ray done. You don't want to step on the scales every day.
Yeah, I do.
There's too much anxiety involved. That's what a financial plan does.
Yeah.
Step on the scale once a year, and then you're done with it.
Deal. Casey, let's come to you. This guy, he went up in his retirement savings, jacked that up for his 401k, and I would imagine the other stuff too. What other kind of planning opportunities should somebody in their 40s like Scott, what should he be thinking about to put himself in a stronger financial position?
Yeah, really, Scott, I think there's probably two primary areas to be thinking about, especially right now. When you're in your 40s, start looking at some of the different tax optimization strategies. So depending on where you're at income, how you give to charity, if that's going to be important, well, that will be much more important, especially with the updates to the Tax Cuts and Jobs Act, depending on the level of giving that you're doing. The other thing is just whether or not you're doing that pre-tax versus Roth contributions, making sure that that is set correctly for yourself, because you still got plenty of time to allow that to grow while also trying to control some of your various different tax liability. And then also review your estate planning items. This is something that I think is really important for a lot of people oftentimes, but you are actually to a point right now where you are actually going to start to see some pretty significant acceleration in terms of your overall net worth. So make sure that you have the estate planning mechanisms in place in order to deal with those various different pieces as they come along, instead of trying to come and do this after the fact.
Yeah, it makes sense to do that, and this is one of the reasons why you have professionals alongside you at Premier Investments and Wealth Management. They've got the Investor's Guide series at premieriwm.com. You can get started on your personal plan at premieriwm.com as well by clicking on Get Started, answer a few questions. They'll provide a one-page Premier Vision document and a free meeting to go over it. It's your financial roadmap for the future, and they'll visit with you about it on a regular basis. And if you have questions about not only that, but everything from daily to weekly to monthly spending all the way up to, maybe I want to leave a legacy for future generations, they can help you with that as well. Premier Investments in Wealth Management at premieriwm.com or call 800-383-6590. Premier Investments in Wealth Management named to Forbes 2026 Best in State Wealth Management Team. My name is Doug Wagner for Dr. Casey Mushrush.
Just you, Doug.
For Jonas Everett and for Elias Randel, who reminds you, go over and above the minimum required when they say get that company match, because you would not want to make Elias Randel angry. You wouldn't like him when he's angry. He's the new sheriff in town. Thank you very much, guys. We'll see you next week here in Premier Investments Wealth Management Financial Program.
What an outro.
Wouldn't like him when he's angry.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs and does not assure a profit or protect against loss. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Contributions to a traditional IRA may be tax-deductible in the contribution year, with current income tax due at withdrawal. Withdrawals prior to age 59.5 may result in a 10% IRS penalty tax in addition to current income tax. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Forbes' Best in State Wealth Management Teams ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.